as brutally honest as possible, it is not pretty in the crypto market right now. Can't lie to you. But here we stand. This is one of the darker sides of participating in such cutting edge technology. Does not look good. If you're not aware, SBF, Sam Bankman-Fried, and FTX, they just filed for bankruptcy. They're one of the largest cryptocurrency exchanges in the world, and they are going through a time right now, and it is affecting the entire market. Does not look pretty at all, but um, a lot of people are losing money right now in the space. If you were overexposed to FTX, you are losing, or you are either in limbo of losing a ton of money, or you lost a ton of money. It's not okay. But we're here for the tech. I mean, it's just part of being on the frontier of cutting edge technology. There's a possibility that you could expose to things like that. But all things are working out on the back end. So today's topic is decentralized finance. The objective of the session is to provide an introductory coverage of decentralized finance, or we call it DeFi, DEFI. We will explore the history of DeFi and how it evolved over the years, what aspects of the traditional financial banking sector it may disrupt in the future. And then we will dive deeper into the DeFi ecosystem and discuss its foundations as well as constituent elements. Then we'll explain the different ingredients and pillars of DeFi are connected and interdependent. The session outline is as follows. We'll go over the DeFi history, the foundations of the DeFi ecosystem, lending and borrowing, the centralized exchanges, DEXs, the DEX, that's what they call them, stable coins, oracles, wallets, non-fungible tokens, and then we'll round it out with our conclusion. So let's first get into DeFi history, the origins of DeFi. There's not a particular date in which decentralized finance was born. Okay. DeFi is part of the broader ecosystem of cryptocurrencies. Bitcoin redefined payments and the concept of stored value, but it did not directly impact the main functions of the traditional financial services industry, like exchange, borrowing and lending, insurance, prediction markets, etc. And the birth of smart contracts by Ethereum are actually what set the foundations for these areas to be disrupted by blockchain. The precursors to DeFi were projects like the DAO and Ether Delta, which were created in 2016 through lived to about 2018. They were hacked, both of them, and they actually failed, but they paved the way for many of the DeFi applications that we use now. Ether Delta was one of the first decentralized exchanges, and it was based on order books like centralized exchanges. It's an inefficient model for a decentralized exchange in terms of cost for market making. It was hacked for around $800K, and the founder was charged by the SEC for operating an unregistered national securities exchange. Early DeFi projects include Maker. It's considered to be the father of DeFi, and the idea was conceived in 2014, and it was not implemented until 2017. It deployed on Ethereum as a smart contract that allowed anyone to put a crypto asset as collateral and borrow a percentage of its value through a stablecoin called DAI. Okay, remember, a stablecoin is any cryptocurrency that is pegged to a fiat or a mixture of fiat and commodities. So it's usually valued at $1. A bit later, many projects that played an important role in the early DeFi ecosystem were born. Among them were Aave, or Aave, it's AAVE, previously called Etherland. It's OX or OX and Synthetics. Important breakthroughs in 2019 through 2020 created the sector we know today and popularized the term DeFi. The most important innovation was the shift from a user-to-user to a user-to-contract interaction model, which was created by Compound Aave. Other important developments in that area were the introduction of liquidity pools and automated market makers, AMMs, by Bancor and Uniswap, and the liquidity incentive program launched by Compound and Synthetics. These really paved the way for the DeFi market we're used to today. The main catalyst for the explosive growth of DeFi in the summer of 2020 was the creation of the notion of yield farming. like farming for yield. As a result, the total value locked, or TVL, and the total market capitalization of the DeFi ecosystem skyrocketed. So TVL, or total value locked, is the total amount of assets that are supplied to or locked in on a DeFi protocol. There's a common misunderstanding that TVL represents the amount of outstanding loans in the DeFi ecosystem, when in actuality, it represents the total amount of underlying supply being secured by a specific decentralized application and or DeFi as a whole. Let's get into the juicy parts. We're going to dive into the foundations of the DeFi ecosystem, creating a money Legos. Now, DeFi implements in the world of crypto services typically provided by the traditional finance system in a way that is aimed to be more efficient in terms of capital allocation, execution time, participation, transparency, security, decision-making, and decentralization. We use the term DeFi ecosystem to refer to the entirety of such services. That's because DeFi can be thought of as a living organism whose different organic systems are connected and dependent on each other to function normally. Similarly, you may conceptualize DeFi as an interconnected system with several intertwined pillars connected in what is sometimes referred to as a money Legos, in which the same building blocks can be reconfigured to create whole new types of services. It's because, in contrast to traditional finance, DeFi protocols are open-ended and permissionless, meaning anyone can participate and help better the structure. Of course, there's competition inside the same pillars of the ecosystem to attract users and assets, but among the different pillars, there's mostly a symbiotic relationship because they realize that most need the other to survive. Some of the common characteristics between DeFi and TradeFi, which is traditional finance, accessibility for DeFi is open to anyone, whereas you must apply and be verified in traditional finance. The custody of funds in DeFi is mostly self-custody, meaning you're in charge, whereas in traditional finance, it's mostly about third parties. The control of funds, the user and smart contracts are what control the funds, whereas with traditional finance, institutions and their partners, and decentralized finance, speed. Final settlement happens in minutes and is irrevocable, can't be changed. Whereas in traditional finance, final settlement can take weeks and it can be changed by the banks. Availability. Markets are open 24/7, 365, and cannot be shut down unless the internet itself is shut down. But even still, there are ways to keep it up. Whereas markets are open in business hours and can be shut down in traditional finance. Transparency. In decentralized finance, it's mostly transparent. Anyone can verify the financial activity of open source protocols on the blockchain. Whereas in traditional finance, it's mostly not transparent, and besides financial statements, you can't ask banks for their loan history or assets under management. Protection. In DeFi, there's auditing, self-verification, and no protection, whereas in traditional finance, there are guarantees about the central bank and regulation. In decentralized finance, the services available are limited but growing, but they're poorly integrated with traditional finance. While as traditional finance, they offer a ton of services, but it's poorly integrated with decentralized finance. The DeFi ecosystem's main pillars. There is no universally accepted categorization of the different pillars of the DeFi ecosystem. Moreover, innovation in the space is moving fast, so any such strict categorization would be short-lived. DeFi projects are basically decentralized applications based on an underlying blockchain, which is called a layer 1 or an L1, as it is the first underlying layer of the DeFi stack. Typically, L1 blockchains include Ethereum, Binance Smart Chain, Polkadot, Solana, and others. DeFi enabling L1s need to support smart contracts, of course, so Bitcoin would not be considered an L1. L1s provide the first and more important line of security of the DeFi ecosystem, responsible for providing the necessary tools that allow DeFi projects to discover and implement application layer innovations. Ethereum is one of the biggest L1s. Until today, it actually has the largest DeFi ecosystem. It was the first platform to focus on smart contracts, which later became the building block of decentralized finance. That gave Ethereum the first mover's advantage it currently has, creating network effects and scales of economy. However, the idea of smart contracts was not new. They were proposed in 1994 by computer scientist Nicosia. Then there's Binance Smart Chain, BSC. was recently emerged as a popular L1 alternative, especially as transaction fees skyrocketed in Ethereum due to the popularity and increased use of DeFi applications there. Interoperability. Until today, L1 blockchains are by and large not interoperable. Hence, different L1s provide the basis for different DeFi ecosystems which do not communicate with each other. A lot of research is being focused currently on the field of L1 interoperability and creating bridges between different protocols. Polkadot and Cosmos are two frameworks focused on blockchain interoperability. That is the word right there, interoperability. An example of cross-chain interoperability implementation between Ethereum and Polkadot is Clever, so the ability for one chain to speak to another and for you to perform services and bridge services from one blockchain to another. So for many, the most important and disruptive part of the DeFi ecosystem is decentralized lending and borrowing. We look at decentralized exchanges. A lot have recently become more popular, attracting volumes similar to the biggest centralized exchanges. A centralized exchange, for example, would be something like Coinbase. Another important pillar of DeFi ecosystem are the stable coins, of course. Then we'll dive into oracles, and we're going to briefly discuss wallets once again. Lending and borrowing. You become your own bank in DeFi. Lending and borrowing, they were the first DeFi applications that gained popularity. Decentralized lending and borrowing platforms are simply smart contracts that let you lend or borrow crypto assets at a fixed or variable interest rate. In other words, they offer exactly what commercial banks offer through deposits and loans. What differs here is that there is no central authority to decide who participates and mediate the whole life cycle of lending and borrowing. There's no need for credit history or other financial records, and anyone can lend their assets and earn interest or deposit some collateral and borrow a percentage of its value. Removing the intermediary is aimed at enhancing the efficiency of capital allocation, cutting costs, and eliminating exclusion and increasing economic privacy and freedom. Some of the trade-offs would be, for the DeFi ecosystem, as a creditor, anyone can include smart contracts. Okay. In traditional finance, it's banks or appointed institutions. For the debtor, anyone, including smart contracts. For traditional finance, better individuals or businesses. As far as interest rates, in decentralized finance, they're set algorithmically by the protocol. In traditional finance, they're set by a central bank, financial institution, and lenders. And decentralized finance collateral, the loans are over collateralized, whereas in traditional finance, they're under collateralized, or there can be unsecured debt. In decentralized finance, maturity, it's fixed or undefined. In traditional finance, it's fixed. Risk to lender. In decentralized finance, it's platform risk, it's protocol risk, it's volatility, it's governance risk, and there's occasionally rug pulls. Whereas in traditional finance, it's based on the credit rating of the borrower. Okay. Risk to borrower, there's the in centralized finance, there's the liquidation or loss of collateral. In traditional finance, there's potential bankruptcy or loss of financial flexibility. Over collateralized loans. This is one of the basis of the DeFi ecosystem, the lending and borrowing ecosystem. DeFi loans are typically over collateralized, meaning that practically a user can borrow less money than the value of the collateral that they deposit. You're going to have to listen in closely for this one to understand why this is a thing. So this decreases the likelihood of insolvency that will result in forced liquidation of a user's position by the smart contract managing the loan. One might naturally ask, why would someone want to borrow money and pay interest when the value of the loan is less than the collateral they already possess and that have locked in? The answer is that borrowers post as collateral assets whose value varies. If someone possesses an asset, the value of which they believe would appreciate in the future, but at the same time they need liquidity, there's a rational incentive to deposit the asset as collateral and borrow part of its value. In this way, if the prediction is correct, the user receives liquidity while continuing to capture the increase of the locked asset's value. They can even use that liquidity to buy more of the provided asset for a multiplicative of returns. However, if the prediction is incorrect and the value of the collateral decreases, the DeFi lending protocol will start liquidating part of the collateral as it approaches the value of the loan in order to repay it or maintain an acceptable loan to collateral ratio. We use something called leverage. To demonstrate why someone may be willing to borrow, even if their collateral is worth more than the loan, we're going to use this scenario. So let's suppose that you deposit your 1 ETH, which is worth 1,500 at the time of you depositing, as loan collateral to platform X with a collateral to loan ratio of 150%. You'd be able to borrow up to 1,000 worth of DAI, which is a stable coin. It's worth so $1,000 worth of a stable coin. And then you proceed to swap your 1,000 DAI for 0.6 worth of ETH at current prices of 1,500. I now own 1.6 ETH valued at 2,500, of which 1 ETH is loan collateral and 0.6 ETH is inside of the wallet because you have bought it from the stablecoin that you borrowed. If the price of ETH were to increase by 10%, the total value of your holdings would be 1.6 ETH still, but you have 2,750 instead. Your profit is $250, meaning $100 more than if you simply just had that 1 Ethereum and did not actually borrow that loan, putting up your 1 ETH that's collateral. So if the price of ETH decreased by 10%, you would lose 250 instead of 100. In reality, your losses would be higher since your collateral will be liquidated due to the price change. So you have effectively used leverage to multiply your potential profits or losses. Leverage is the use of debt to amplify returns and losses from an investment. You can even redeposit your ETH to borrow more DAI and swap it for ETH to increase your leverage and profit and or losses. The money Lego nature of DeFi even allows other decentralized apps to do this automatically for you. The cool thing about it, I like automation. One of the main platforms is Maker. The first DeFi lending borrowing platform on the market was Maker, a protocol that initially allowed users to deposit Ethereum and receive 50% of its value as loan denominated in an algorithmic stablecoin called DAI, which was issued accordingly after a user deposited the ETH collateral. DAI circulating supply is algorithmically regulated based on the overall value of locked collaterals, the demand for loans, and their repayment. Nowadays, Maker has evolved to offer a variety of services, a variety of assets to deposit as collateral beyond Ethereum, and it's also governed in a decentralized way. They have a DAO now, it's called Maker DAO. Its total value locked in July 2021 was around $6 billion. Another main platform is Aave. It began its ETH land during the ICO, initial coin offering era in 2017. And it started as a peer-to-peer platform, meaning that a user who wanted a loan had to find another user to take the other side of the loan and mutually agree on the specific terms. That was an inefficient model. And the resulting use of the platform was limited. But success came after the shift to a model of a pool of funds. Users then, were interacting with a smart contract and not with other users directly. Funds from the lenders are gathered into a common pool, which has specific and predetermined rules. Borrowers under this model had immediate access to loans, provided that the pool had enough liquidity. Aave also were the first to introduce the revolutionary idea of flash loans. These are incredibly interesting, where someone can borrow funds with zero collateral under specific circumstances and for a limited amount of time. If you ever have the chance, please look up flash loans. They're insane. Aave was originally deployed on Ethereum, but has recently also launched on Polygon as well. And its TVL in April 2021 was around 9 billion with a B, 9 billion with a B. So another main platform is Compound. Compound is another large lending borrowing project that has also introduced some innovative concepts which help the whole DeFi lending space to evolve. The liquidity mining mechanism that Compound implemented is a mechanism that was later copied and extended by many other projects and attracted many users to DeFi lending. The mechanism introduced extra incentives to lenders and borrowers to use their platform in the form of distributing the platform's native comp token to the users. That led to the creation of the notion of yield farming, which described the situation of users being incentivized to switch back and forth between lending and borrowing among different tokens in order to achieve the best yield possible. Compound has today the largest TVL among DeFi protocols, which is above 10 billion. 10 billion with a B, not millions. I'm talking about billions here. Decentralized exchanges. Let's dive deeper into decentralized exchanges, or DEX, DEX. What is a decentralized exchange? Well, it is a decentralized application based on smart contracts, enabling its users to perform peer-to-peer, me-to-you token swaps without the intervention of a third party. The main innovation and difference of a decentralized exchange compared to a centralized exchange like Coinbase or Binance is allowing users to trade directly from their wallets without having to trust an exchange for the custody of their funds. Your keys, your money. In other words, users have full control of their funds and privacy in their transactions. No KYC required. KYC is know your customer. What is an automated market maker? An automated market maker is a special type of decentralized exchange. They're algorithmic agents that provide liquidity in markets through holding reserves of a token pair. In contrast with order book models typically used in centralized exchanges, an AMM model, funds are reserved in liquidity pools, and the exchange rate between tokens is determined algorithmically. Most DeFi decentralized exchanges today follow the AMM model. What is a liquidity pool, or an LP? They're one of the most foundational mechanisms in the current DeFi ecosystem. They're essentially part of AMMs, lending, borrowing platforms, yield farming, synthetic assets, on-chain insurance, etc. A liquidity pool is simply a collection of funds which are locked in a smart contract. They are used to facilitate decentralized trading, lending, and many more functions in the DeFi ecosystem. Bancor was the first protocol that utilized the mechanism of liquidity pools, but the concept became really popular when it was introduced by Uniswap. Today, the vast majority of decentralized exchanges function under the LP model, with very few using the order book model. Other popular decentralized exchanges, or AMMs, that are LPs are SushiSwap, PancakeSwap, Curve, and Balancer. I really like PancakeSwap. I haven't used SushiSwap much, but PancakeSwap is actually really cool. Check that out when you have the time as well. What is a decentralized exchange aggregator, or a DEX aggregator? Well, aggregators are friendly protocols built on top of decentralized exchanges to provide users with deeper liquidity. Aggregators, as their name suggests, search liquidity pools across decentralized exchanges to provide a user with the best possible price for a particular trading pair. Aggregators retain all the advantages that decentralized exchanges offer to users, such as privacy and full control of funds, and they typically also offer better execution prices for a token swap. However, due to the fact that through an aggregator you may transact with more than one decentralized exchange, transaction fees can be higher. This is why aggregators are typically used for big trades, which may result in a large price slippage. Why liquidity pools and AMMs? Decentralized exchanges did not really become popular until Uniswap implemented the mechanism of liquidity pools and aggregator market makers. Until then, DEX trading was similar to centralized ones, an example with bid-ask order books. However, this presented a big problem. Exchanges that use order books are heavily dependent on market makers for liquidity provision. In theory, market makers provide liquidity without affecting the direction of the price. To do so, they may engage in many trades. In centralized exchanges, market makers will typically not pay trading fees for their service they provide. Indeed, they may get paid by the exchange. However, in decentralized exchanges, all trades are on-chain. An example, using and recorded on the blockchain that the decentralized exchange is built on Ethereum. So Ethereum is a great example. Users connect their wallets to the smart contracts, and there's no exchange to regulate the fees. So decentralized exchange market makers would have to pay their trading costs like all market participants. On top of that, they would have to wait for the block confirmation time. So it's expensive and comparatively slow, and it created a huge liquidity problem for decentralized exchanges. And that's the problem that the liquidity pools are here to provide, that anyone can provide liquidity on a pair traded on a decentralized exchange, thus becoming a market maker and being rewarded for that. The introduction of liquidity pools led to an explosive adoption of decentralized exchanges. So to use a DEX, the user must connect a compatible wallet, like if it's on Ethereum, they use MetaMask, but it's also been open to use on Binance as well. So connecting a wallet to a DEX basically means allowing the DEX smart contract to view the wallet content, and depending on the approvals provided by the user, transacting on specific tokens up to specific amounts or without limit. Decentralized exchanges interfaces are typically very simple and user-friendly. Let's dive into impermanent loss. This is scary. A permanent loss is a temporary loss caused to a liquidity pool due to the price volatility of the tokens they provide. So it's AMMs, automated market makers, like order books and centralized parties. They rely on market force for price discovery. This means that price changes are not immediately affected on AMMs. As a result, there are often price discrepancies between their price on centralized exchanges and automated market makers. Arbitrageurs discover those discrepancies and execute favorable trades. Liquidity pools suffer impermanent loss by being at the receiving end of the arbitrage. And permanent loss is essentially the difference between providing tokens versus holding them. The more volatile the token, the higher their exposure to impermanent loss. Why is the loss impermanent or temporary? If the price of the staked tokens returned to their original price, the impermanent loss is neutralized. If the liquidity pool chooses to withdraw their funds, then permanent loss is realized and becomes permanent. And permanent loss can be mitigated to an extent by supplying less volatile tokens, same pegged stablecoins, opting for one-sided liquidity pools, and by participating in uneven pools. An example would be Ethereum. You have 10 Ethereum inside of a pool with its price being 1,500, the total value being 3,000 because you have DAI providing DAI in there as liquidity for 1,500 of it, DAI at $1 each, making the total value 30,000. So suppose that the price of Ethereum increases from 1,500 to 1,600 per unit. This would incentivize arbitrageurs to buy the cheaper Ethereum in the pool, buy it at that 1,500 instead of for the 1,600 price, until there is no price discrepancy. They will be able to buy 0.32 ETH in exchange for 496 DAI before the price of Ethereum in the pool reaches 1,600 and is at equilibrium with the market. The liquidity pool would still realize profits, but not as much as if they simply held the token. So let's say if you supplied 9.68 Ethereum with the price of it being 1,600, and there was 15,496 DAI all at $1, the total value would be 30,984. Whereas if you held the token and you had 10 Ethereum in, it was at 1,600, you had 1,500 DAI at $1 each, your total value would be 3,100. If impermanent loss makes supplying assets to a liquidity pool less profitable than holding, then one might wonder why you become a liquidity provider. Well, the answer is that AMMs compensate liquidity providers in a various amount of ways for the services they provide. They charge a small swapping fee for their service. In Uniswap, for example, swapping fee is 0.3% applicable to all trades. Then they use those fees to reward the liquidity providers. So once a liquidity provider withdraws the provided funds, they receive an amount of fees proportional to their share of liquidity of the liquidity pool and to the time that they provided the liquidity. In addition to the fees, they reward their liquidity providers in other ways, sometimes with governance tokens. Governance tokens are used for voting on proposals that determine the future of the AMM. They can also be used in the market sometimes, and sometimes they also give the individuals airdrops, meaning they send tokens or rewards to their wallet directly. Let's dive into stablecoins. Stablecoins already. Remember that stablecoins are cryptocurrency tokens that are meant to hold a stable value against another asset like the US dollar. There are different types. There are fiat-backed stablecoins that collateralized by fiat currencies like the dollar. There are crypto-backed stablecoins like DAI that collateralized by a cryptocurrency or a basket of cryptocurrencies. There are asset-backed stablecoins that collateralized by a single or multiple real-world assets other than fiat currencies. And there's algorithmic stablecoins. Use algorithmic strategies to achieve price stability, and they're not fully backed by any. There are a ton of them. There's Tether, TrueUSD, Circle, Paxos, Stasis, Monerium. There's Maker, BitUSD, Haven, Aurora. There's Basis, Reserve, Carbon, BitBay, Terra Luna. There's Gibril Network. There's Bridgecoin. There's Hello Gold. There's Topple, Freedom, Public. There's so many. Stablecoins for DeFi. They're used for many purposes in the DeFi ecosystem, such as being a store of value, trading, loans. The vast majority of DeFi loans are taken in stablecoins. Algorithmic stablecoins, otherwise non-collateralized stablecoins, are the newest category of stablecoins. They're generally not backed by any asset, at least not fully, and instead they depend on algorithms and smart contracts to control the supply of the issued token. Their financial power does not rely on a central entity or unaudited backup but on a formula balancing demand and supply to maintain a stable price for the token. An algorithmic stablecoin will reduce the token supply if it remains under the price of the fiat currency it represents. Conversely, if its price exceeds the fiat one, additional tokens will be issued until price decreases to be equal to the fiat's price. Diving into oracles. I'm pretty new to oracles myself, but this is an interesting topic. So, connecting smart contracts to the outside world, there are many cases where smart contracts need data from the real world to function properly. For instance, in decentralized prediction markets, in order for a market to be settled and the winners to be paid, the outcome of the relevant real-world event need to be determined. The problem is that blockchain smart contracts cannot directly access data outside of the network in a trusted way. So oracles act as an intermediary between blockchains and the real world by feeding real-world data relevant to a contractual agreement into a smart contract. Okay. As information triggers state changes on the blockchain, and smart contracts are able to function properly. The main challenge blockchains face with oracles is that they need to trust the outside sources of information. Such information comes from centralized parties like websites, sensors, etc. Oracles usually take feed from multiple external resources to minimize risk and avoid a central point of failure. Types of oracles. There are two main types of oracles, blockchain oracles, and they're depending on the way that they allow blockchain to interact with the real world. There are inbound oracles, provide data from the external real world to blockchain smart contracts. And there are outbound oracles that provide smart contracts with the ability to send data to the outside world. Depending on their implementation, we can distinguish oracles into software oracles. They're the ones that handle information data coming from the internet. An example, price assets from the website. There are hardware oracles used when smart contracts need information directly from the physical world. An example, the Internet of Things sensors. And then there are consensus-based oracles. They get their data from human consensus, for example, to avoid market manipulation. Prediction markets implement a rating system where different users vote on the outcome in question, and they're weighed by rating average. Is transmitting to the inquiring smart contract. An example, there's Chainlink. It's the most widely used blockchain oracle in the DeFi ecosystem. I'm going to touch on wallets. Crypto wallets for DeFi. DeFi wallets can be used as regular wallets, but also allowing us to interact with the DeFi ecosystem. That being said, DeFi wallets are a crucial part of the whole DeFi ecosystem because without them, it would be impossible for users to interact with the DeFi ecosystem. They act as the gateways for interacting securely with DeFi applications, and at the same time, they are non-custodial, which means that users can store their assets without having to depend on third parties. Now, DeFi wallets have to be compatible with token standards set by the L1 blockchain of the DeFi ecosystem and should be able to support a wide range of tokens. An example being compatible with ERC20, Ethereum request for comment number 20, standard in Ethereum's network. So some of the characteristics of a good DeFi wallet should be that it's non-custodial. No third party should have any kind of access control over the funds except for explicitly provided funds. It should be able to hold multiple assets. It should be compatible with any kind of DeFi application. One of the examples is MetaMask, M-E-T-A-M-A-S-K. It's the most widely used DeFi wallet in the ecosystem today, and it's an extension you can use on the Google Chrome browser or download as an app. It uses a 12-word passphrase, which can be used to access the wallet from any device or stored in case it's lost. Many of them are easy to use, but they generally haven't been designed with security as its prime concern. And you can also access a lot of the DeFi applications directly from your wallet. You can swap tokens from your wallet using MetaMask or most DeFi wallets that you have. Another one for so long would be Phantom. And there's also a Trust wallet. It's a multi-coin wallet. You can hold multiple currencies in it from multiple blockchains. The art of digitization. We're going to get into non-fungible tokens or NFTs. So the potential of blockchain technology is not limited to cryptocurrencies. So non-fungible tokens, think of that almost everything in the world is unique. They're not interchangeable. Your phone, personal suitcase, house, car, dog, they're all unique. Non-fungible tokens, NFTs, they're another blockchain-based token type that enable exchange of ownership of unique digital items. And they introduce a new wave of proof of ownership. So NFTs' unique attributes include indivisibility, meaning they cannot be split into smaller denominations. You cannot purchase 10% of a plane ticket. Actually, that is changing, where you can fractionalize them and own percentages and pieces of them. Composability, the ability of a token to combine different NFTs to represent a combination of different digital assets. There's scarcity, NFT creator that can generate as many assets as they like and thus drive the value. CryptoPunks are an example. There's 10,000 of them. Uniqueness, they're not interchangeable. No two NFTs are the same. Ownership, creators can control the private keys of their NFT creation, and they're able to transfer them to any account. Transparency, the records of the token issuance, transfer, and activity can be publicly verified. And interoperability, they could be traded, purchased, or sold across different blockchains or DLTs, distributed ledger technologies. The NFT hype, well, the NFT market has experienced explosive growth over the past months. And last year, the NFT market traded about 250 million, while currently, in the quarter three of 2021, the NFT market traded more than 2,000. The percentage increased more than 2,000%, which was about 5 billion. There are a ton of NFT standards that are in place, from the ERC20, which is introduced fungible tokens into the Ethereum blockchain. There's the ERC721, which introduced non-fungible tokens in Ethereum and the whole blockchain ecosystem. There's ERC. It also defined a minimum interface, a smart contract must implement to allow unique tokens to be managed, owned, and traded in Ethereum blockchain. There's the ERC1155. It enabled the management of multiple token types and a single deployed contract to increase the bytecode on the Ethereum blockchain. There are other non-Ethereum blockchains that support NFTs, such as Polygon, Hedera Hashgraph, Near, Flow, Affinity, Binance Smart Chain, ton of NFT marketplaces like OpenSea, Super Rare, Foundation, Rarible, Magic Eden, JPEG Store, JPG.store. Cardano is another blockchain that supports them. There's a ton more. It just goes on. There are some that are focused on gaming. Some NFT marketplaces are focused on gaming, such as Axie Infinity, So Rare, Decentraland, OpenSea, The Sandbox, Engine X. While the others are mainly focused on NFT art, like OpenSea, Super Rare, Rarible, Nifty Gateway, Foundation. There are some that are focused on music as well, such as async art. And they move into the metaverse with these things. They have Ready Player One, like NFTs that you can actually participate in the metaverse with. They actually are launching a class, an open source, an MOOC, a massive open online course at the University of Nicosia, where you can participate in for free. It's being held inside the metaverse. It's really interesting. I would recommend checking out the University of Nicosia. That is where the information for this 2-week course has been from. Great information, great team, great teachers. I want to wrap up with a conclusion. I know we went over a lot in a little amount of time, but this is for you to replay. Just pick out the pieces that you need. So in this session, we explored the origins of DeFi and its history. We saw that most of the pieces of the DeFi ecosystem pre-existed 2020 into summer of 2020, when DeFi became wildly popular. Projects like Maker, Aave, Compound, and Synthetics, and innovative mechanisms like AMMs, liquidity providers, liquidity mining, and yield farming, they played a crucial role in the adoption of DeFi. The whole DeFi space today, as of April 2021, has a market valuation of over 100 billion and CVL around 60 billion. We saw that the whole DeFi stack is constituted by many different pieces, which are constantly evolving and growing, with new pieces continuously being added. In a big part, all these projects are interconnected and interdependent. The main pillars of the DeFi ecosystem are lending and borrowing platforms, decentralized exchanges, stablecoins, oracles, wallets, and others that are not covered in this session, such as synthetic assets and DAOs. We went over lending and borrowing platforms, which allow users to lend and borrow assets, operating without a central authority or a need for credit history or other financial records. We went over DEXs, decentralized exchanges like Uniswap, PancakeSwap, and SushiSwap, and the mass adoption that came with the introduction of AMMs and LLPs. We went over wallets, stablecoins, and oracles. They're the tools that support the whole ecosystem and make it functional. And wallets enable users to interact with DeFi projects in a simple way. Stablecoins are extremely extensively used in lending and borrowing platforms, and how oracles are feeding real-world data otherwise inaccessible to blockchains and smart contracts. Check all this stuff out. Go back through this. Check out all the pieces of it. Just give. You don't have to give the entire thing your attention. To give some of it your attention. It's worth it. It's worth checking out, understanding the pieces of it, the bits and pieces of it, because you may not have this implemented in your life at the moment, but you will at some point. If not for you to learn yourself, teach it to those around you. Let those around you pick up on it, like your children's children know about these things, because this is going to be in their future. Thank you for everyone who tuned in. This is great. This was a great 2-week session. I only got to stream part of it live here on Facebook. But to everyone who attended in this class, thank you. I'm grateful for you showing up, and I hope there's something that you take away from all this that you can use in your day-to-day or in your future. It was great being here. Hope everyone has a great day and